In this video, we're going to be performing a deep dive on Cintas Corporation's dividend safety. To begin, let's talk about Cintas Corporation's business model. Cintas Corporation is the U.S. industry leader in uniform design, manufacturing, and rental. The company also offers first aid supplies, safety services, and other business-related services. It was founded in 1968 and has grown to a market capitalization of $21 billion and annual revenues of almost $7 billion. Cintas's CEO is Scott Farmer, the son of its founder Richard Farmer, and owns more than 14% of Cintas stock, which shows that company's upper management is incentivized to act in the best interests of its shareholders. Cintas Corporation is a well-known dividend stock because of its compelling track record of dividend growth. With 35 years of consecutive dividend increases, Cintas Corporation is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. Looking ahead, investors interested in owning Cintas stock should have a deep understanding of the safety of the company's current dividend payments. For the remainder of this video, we will discuss the company's current dividend safety from four perspectives. 1. Its dividend safety in the context of its current earnings. 2. Its dividend safety in the context of its current free cash flow. 3. Its dividend safety in the context of its recession performance. 4. Its dividend safety in the context of its current debt load. First, let's discuss Cintas Corporation's dividend safety in the context of the company's current earnings. When Cintas Corporation announced its second quarter financial results on December 20th, the company reported that it generated earnings per share of $8.44 through the previous 4 quarters. For context, Cintas Corporation paid $2.05 of common share dividends during the same time period for a dividend payout ratio of 24%. Using earnings, Cintas Corporation's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method of assessing dividend safety. Accordingly, we will now compare Cintas Corporation's current dividend payment to its free cash flow. During the past 4 quarters, Cintas Corporation generated $930 million of cash from operating activities and spent $277 million on capital expenditures for a free cash flow of $653 million. The company distributed $176 million of common share dividends during the same time period for a free cash flow dividend payout ratio of 27%. Using free cash flow, our conclusion is the same as when we used earnings to measure Cintas Corporation's dividend safety. The company's dividend appears safe for the foreseeable future. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Cintas Corporation's current dividend safety in the context of the company's historical recession performance. We believe the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Cintas Corporation's performance during this time period is shown here. Cintas Corporation's earnings per share declined by 31% peak to trough during the last recession. More importantly, however, the company's earnings continued to cover its dividend, and it continued its multi-decade streak of consecutive dividend increases. Accordingly, we have no concerns about the company's ability to pay rising dividends during future economic downturns. The last angle that we will use to assess Cintas Corporation's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before the company's free cash flow will no longer cover its dividend payment. In fiscal 2018, Cintas Corporation generated $110 million of interest expense and had $2.5 billion of debt outstanding for a weighted average interest rate of 4.4%. The following image shows how changes to Cintas Corporation's weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As the image shows, Cintas Corporation's weighted average interest rate would need to rise above the 23% level before its dividend would no longer be covered by free cash flow. Accordingly, we believe that Cintas Corporation's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Cintas Corporation's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.